If you want to start investing, you're probably stuck on one question. Should I buy individual stocks or just start with ETFs? If I had to start investing again from scratch, I would not begin by picking stocks. I would start with ETFs. Not because ETFs are perfect, but because for most beginners, they're simpler, less stressful, and much easier to stick with. So in this video, I will share the 3 reasons I'd choose ETFs over stocks if I were starting again, and why that decision matters so much in the long run. Hi, I'm Cici, a chartered accountant with a master's degree in finance, and I simplify personal finance and investing so you can understand the money and build long-term wealth. So first, what exactly is an ETF? An ETF is basically a fund that lets you invest in many companies in one go. So instead of putting all your money into just one company, you are spreading it across a basket of companies. If buying one stock is like choosing one football player and hoping that player performs well, buying an ETF is more like owning a piece of the whole team. And for beginners, that can make investing feel much simpler and much less stressful. So here are the 3 main reasons I'd choose ETFs over stocks. The first reason is simple. They save time. And honestly, this is a huge one for me, because I do not want investing to become a second job. Researching and picking individual stocks takes time, a lot of time. You need to understand the company's financials, its competitive positions, its management team, its industry trends, and then you need to keep monitoring it constantly to see whether your original idea is still right. That might be fine if you genuinely enjoy that and have time to do it. But for most people, especially beginners, it's just not realistic. I have a full-time job. I have a family. I want my money working for me. But I don't want to spend hours managing it. That's why ETFs make so much sense to me. Of course, you still need to spend some time choosing ETF you trust. There are still options, but choosing between some well-known ETFs is much easier than trying to choose from thousands of individual stocks. It takes less time, less technical knowledge, and much less ongoing effort. You don't need to become expert in financial statements, you don't need to spend hours trying to calculate fair value, and you don't need to keep up with every bit of company's news. You can keep it much simpler. You can set up a monthly direct debit, invest regularly, and get on with your life. And I really believe that matters, because time has value. Every hour you spend trying to analyze stocks is an hour you cannot spend somewhere else. Instead of spending your evenings studying financial reports, you could use that time to grow your career, build a side hustle, earn more money, and then invest that extra money back into ETFs. And for many people, that can actually be a better use of their time. Or if that's not your priority, simply use that time for the things that matter most to you: your family, your health, your life, and let money grow quietly in the background. To me, that's a much better trade-off. Simpler, lighter, and much easier to manage. The second reason is risk. Now I want to be clear here. I'm not saying ETFs are risk-free. They are not. ETFs can still fall. If the market drops, your ETF will probably drop too. But here's the key difference between ETFs and individual stocks. With one company, if you get that decision badly wrong, the damage can be huge. Just think about Enron or Lehman Brothers. They were once seen as strong, reliable companies. But when they collapsed, many shareholders lost almost everything. With a broad ETF, it's different. You're not betting on one management team. You're not depending on one company's future. You're spreading your money across hundreds or thousands of businesses. So if some companies fail and some well, the others carry on. That also means a broad ETF is much less likely to leave you with nothing just because one company collapses. And that matters emotionally too. Because for most beginners, it is much easier to trust the long-term growth of the wide market than to trust that you personally pick the right company. And that matters more than you think, because investing is not just about numbers, it's also about behavior. It is about whether you can stay calm when prices fall, and whether you can stop yourselves from panicking and stay invested long enough to actually benefit. Well, this is something I experienced personally. When I first started investing, it was during the pandemic. Not long after I bought in, prices started falling, and they kept falling. I understood investing, so I knew market drops were part of the process. But my husband wasn't really into investing at the time, so every time prices fell, he would immediately show me the account and say, with this worried look on his face, Look, it's down again." And every month, he kept wanting me to sell. Not because he was silly, not because he was irrational, just because when you are new to investing, red numbers feel scary. And honestly, I think that is a very normal human reaction. And I want to be honest, even with the ETF, the price can still fall sharply, just like the market did during the 2008 financial crisis. But here's the difference. When ETF drops, you are not asking yourself, will this one company survive? You are asking, will the broader market recover? And historically, markets have recovered from major crashes over time. That, I think, makes it a little easier to hold on. And that matters because investing, the real damage often comes not just from the fall itself, but from selling in panic before the recovery happens. We've seen broad market ETFs recover from major falls time and time again. And over the long run, the overall direction has still been upward. That is why staying invested matters. If you sell in the middle of the drop, you lock in the loss and risk missing the recovery. And I think that is exactly why ETFs can be easier for beginners to hold. With a single stock, it is much harder to stay calm when you are not completely sure whether that one company will recover. But with a broad ETF, it's much easier to believe that the broader market will recover than to believe that one company picked will be okay. Long-term wealth is built by staying invested long enough for recovery, growth, and compounding to do their job. Of course, even with a broad ETF, you may still feel nervous in the beginning. You may still check prices too often. You may still feel tempted to sell if the market falls right after you buy. That is why I think beginners should start with an amount they can emotionally handle. Maybe that's £100 a month, maybe £200. So how do you know what's right for you? A good question to ask yourself is this. If this investment fell by 20%, would I still be able to sleep at night? If the answer is no, then your amount is probably too high. Start smaller, give yourself time, let yourself get used to the ups and the downs. Because over time, the panic usually gets weaker and the confidence gets stronger. That's one of the reasons I think ETFs are so beginner-friendly. Not because they remove risk, but because they reduce the chance that one bad decision destroys your confidence right at the beginning. The third reason is that ETFs makes it much easier to get started. And when it's easier to get started, you are much more likely to start earlier. And this is something I feel personally about because I made this mistake myself. Before I started investing, I thought I needed to be ready. I thought I needed to understand how to read financial reports, how to value a company, how to follow the news, and work out which direction a stock was heading. So I bought a lot of books and researched online, trying to feel confident enough to finally press the button. And the whole time, I told myself I will start soon. Once I understand this a bit better, once I felt ready. I thought I was preparing, but looking back, I was really just delaying, and that delay had a cost. Because while I was busy trying to feel more ready, my money was still sitting in the bank and losing value to inflation. And that is exactly why I think ETFs are so helpful for beginners. They lower the barrier to get started. You do not need to know everything about analyzing individual companies before you begin. You do not need to spend years trying to become a stock picker. You can start with something much simpler, and that gives compounding more time to work. Because in investing, starting early often matters more than starting perfectly. That is why, if I was starting again, I would care much less about perfect timing and much more about starting early and staying consistent. Let me show you what that delay actually costs in real numbers. Say you invest £500 a month, assuming an average annual return of 8%. If you start today and invest for 25 years, you'd end up with roughly £475,000. But if you wait just 3 years, same amount, same return, that drops to around £358,000. And if you wait 5 years, it falls further to around £295,000. That 3-year delay could cost you about £117,000. Wait 5 years, and the gap grows to around £180,000. I think about my own year of waiting and what it cost me. Not just in money, but in the habit of investing, the confidence, the experience of watching your money grow. So if you're sitting there thinking, I will start once I know more, I want to hear this. The best time to start was last year. The second best time is today. So, if I had to start investing again, I would keep it simple. I would not begin by trying to pick individual stocks. I would start with ETFs. Because for most beginners, they save time, reduce the risk of one big mistake, and make it easier to start. And I really think that matters because at the beginning, the goal is not to find the perfect investment. The goal is to find something simple enough that you can actually start and stick with it for years. That is how long-term wealth is built. If this helped you feel a bit more confident about starting, give the video a like and subscribe so you don't miss the next video. Thanks for watching, and I will see you in the next one.